Welcome back to The Explainer. Today, we're unpacking a genuine earnings paradox at one of Wall Street's absolute heaviest hitters, Goldman Sachs. We're looking at a blowout quarter, a massive multi-billion-dollar pivot, and yet a totally surprising stock reaction. If you want to really understand the mechanics of modern high finance, what actually drives market expectations, and exactly where this banking giant is heading in 2026 and beyond, well, you're in the right place. Let's get into it.
Okay, let's dive into this. To understand the current landscape, we've got to start with the raw numbers from their recent quarter. And honestly, they are staggering. Goldman Sachs reported diluted earnings per share of $20.98. The estimate, just $14.47. That is a massive 44% earnings beat. To put that into perspective, that represents a 92% surge in earnings per share compared to this exact same quarter last year. So, they didn't just beat the street, they completely shattered expectations across the board, proving their sheer dominance.
But what actually drove those record numbers? Let's break down that $20.34 billion revenue pie. The biggest piece, by far, is global banking and markets. That came in at a record $15.52 billion. That's up 53% year over year, heavily fueled by a massive jump in equities and a really strong showing in fixed income, currencies, and commodities. Meanwhile, asset and wealth management hit $4.60 billion. This segment saw a 20% increase, pushing assets under supervision to a record $4.04 trillion thanks to some huge net inflows. And finally, investment banking fees surged 55% to $3.40 billion. As CEO David Solomon pointed out, clients are returning to Goldman for their most strategic transactions. This deal-making engine, it is literally firing on all cylinders. So what does this all mean? Hearing about a record-shattering quarter like that, you'd naturally think the stock would be rocketing to the moon, right? And initially, in pre-market trading, it actually did rise nearly 3%. But here is the central mystery. If the numbers were undeniably this good, why has the stock lost about 10% of its value since the report? Right now, it's hovering just above $1,027, trading near the middle of its 52-week range. Seriously, how does a company post a 44% earnings beat and get rewarded with a 10% haircut? Now, what's really interesting about this slide is the sheer contrast between the lead-up and the aftermath. We're looking at a textbook case of market psychology. Buy the rumor, sell the news. Heading into this earnings report, Goldman's stock had already gone on a massive 51% run-up over the past year. Expectations were incredibly, almost impossibly high. So when the news finally dropped, even though it was historically fantastic, a lot of investors simply decided to take some profits off the table, and that led to the 10% dip. The market had basically already priced in perfection. And this dynamic has created a pretty fascinating split in how analysts view the stock going forward. The consensus rating right now is a cautious hold, with an average one-year price target of $1,170, which, to be fair, still represents about a 15% upside from where it's sitting today. But then, you've got the heavy hitters who remain incredibly bullish. Jefferies is maintaining a buy rating with a highly optimistic $12.99 price target. Wells Fargo also reiterated their buy, and they actually raised their target to $11.95, citing deep confidence in the firm's trajectory. So the market absolutely acknowledges the phenomenal performance, but that stretched valuation is definitely keeping some analysts firmly on the fence. Section 1. The NEOS acquisition, a $2.25 billion strategic pivot. Now, while analysts are debating the current valuation, Goldman Sachs isn't just sitting still. Let's look to the future, specifically a massive move that could fundamentally reshape their entire business model. This planned acquisition of NEOS Investments, which is expected to close in early 2027, isn't just some bolt-on purchase. It brings in about $30 billion in assets across 19 funds. But more importantly, NEOS is a pioneer in options-based income ETFs. By absorbing them, Goldman instantly scales its footprint to become the 8th largest active ETF manager globally. Plus, it aggressively pushes them into the derivatives income space. We're talking about a sector that has exploded with a 70% compound annual growth rate since 2021. And this brilliantly illustrates Goldman's broader strategy. See, historically, revenues from trading and M&A are kind of lumpy. They boom and then they bust. The ETF business, though, it provides a smooth, durable, recurring fee-based highway of income that can weather volatile market environments and balance out those unpredictable trading desks. Section 2. Risks and the road ahead. Of course, we have to look at the internal pressure too. We saw a 26% jump in operating expenses, bringing the total to $11.67 billion for the second quarter. So the crucial point is that while revenues are hitting record highs, the cost of doing business is also soaring right alongside them. This surge is primarily driven by higher compensation and benefits expenses. Now, sure, paying your top performers more is directly tied to the firm's stellar performance. You absolutely have to reward the dealmakers, but ultimately, that 26% increase is eating directly into those record profits. So let's summarize this fundamental tension right now. Over on the bull side, you have undeniable capital strength. We're looking at a highly robust CET1 ratio of 12.9%. You've got a record pipeline, and that deal-making flywheel is spinning faster than it has in years, fully backed by smart, recurring revenue plays like the NEOS acquisition. But on the bear side, you have to weigh all that against a lofty valuation that demands absolute perfection, along with those sharply rising internal compensation costs. Plus, you've got broader macroeconomic factors at play. Any sudden shocks, whether it's geopolitical events shaking global confidence or unexpected shifts in interest rate policy, could quickly freeze up that lucrative M&A and IPO pipeline we just talked about. This would put immense pressure on the stock. It's really a classic clash: fundamental business strength versus macroeconomic vulnerability. Which brings us to the ultimate question we want to leave you with today. Does the current stock price already perfectly reflect this future success, or is it wiser to hold off and wait for a further pullback as a potential entry point? Goldman Sachs is undoubtedly a high-quality business, executing its strategy at the absolute highest level and delivering one of its best quarters ever. But the market is always forward-looking, and the price of admission right now is exacting. Just think about how that 2027 NEOS integration is going to play out against those rising internal costs. Thank you so much for joining me for this explainer. Keep this question in mind as you watch the markets this week, and we'll see you next time as we continue to unpack the strategies shaping the financial world.